Well, with all the nonstop talk about the internet, Web 2.0, Google, YouTube, well, the list goes on, you might not have thought much lately about IBM. The so-called granddaddy of tech has slowly morphed itself into the #1 IT services provider, not to mention a leader in hardware and software. And while Big Blue has been quietly cruising under the radar lately, our next guest says this sleeper stock is definitely worth a closer look. Here to tell us why is Barry Ritholtz, Chief Investment Officer at Ritholtz Capital Partners. Barry, welcome back. It's good to see you again.
Thanks for having me, Sue.
You know, it is interesting because with all of the, new names on the block and the stock performance by the likes of Google, IBM has really gotten overlooked, but there are a lot of positive things going on at this company.
That's right. It is a sleeper stock, and we like to be a little contrarian, look for things that the rest of the street hasn't picked up on. You know, IBM has surprised the street for the past 5 quarters. They've beaten to the upside. And look, we're a little cautious going into next year. We think the economy is going to slow down. A big defensive name like IBM is a place to hide. It's a place that it won't get hit in the event the market runs into a little turmoil.
It also favors the large cap. I mean, it is a large cap, so the rotation from the market out of small and mid caps into large caps, which is what's going on now, also plays in its favor, does it not?
That's exactly right. We've been very negative on the big caps until this summer when we started to see the rotation. It actually began in May when the big caps fell much less than the small and medium caps did. And since that point, since June, July of this summer, we've seen the big caps do well.
What about the software side of things, which is something that IBM has not traditionally been known for, but obviously it's a big player in it?
That's exactly right, and that's where the hidden value is in IBM. And it seems funny to say that. You know, people think of IBM, especially since 2000, they're still off about 30%, but the new CEO has been in place for about 4 years. He got rid of the hardware division. They're not making PCs or laptops anymore, and they've gone on an acquisition spree. They've actually accumulated about 30 separate smaller software companies. They've spent about $5 billion on this on the past few years. The interesting thing about software is it's only 20% of IBM's revenue, but it's 40% of their profits, and they're really not getting a multiple like the rest of the software sector is.
So what kind of a price target? I mean, it varies depending on who you talk to on the street, but what do you think, where do you think the stock is fairly valued?
Well, we don't do price targets, but Deutsche Bank just had a piece out yesterday. They put a $105 target, which would mean IBM is 25% undervalued over here. If you look at the cost and the PE of IBM, you know, they're trading at about 16 times trailing earnings. Compare that with the Dow is about 23, and some of their bigger software competitors like Microsoft or Oracle, they're in the mid to high 20s. So on a valuation basis, considering almost half their profit comes from software, they're really not getting that sort of multiple.
But one thing that people do want these days, once again, is dividends. Dividends are back in vogue, and that's one of the complaints about the stock.
Well, for a tech company or a services company, you know, a 1.4% dividend yield, it doesn't compare to the oils or to the financials, but as far as tech companies go, that's a fairly respectable yield. I mean, look what Microsoft pays is small, and look at Cisco's and Oracle's, they pay nothing. So if you're thinking about dividends and you want some software exposure, IBM is an intriguing name.
Barry, thanks.
My
Good to
pleasure.
see you
Thanks,
again.
Sue.
Barry Ritholtz joining us.